Hello and welcome. You're watching Macros with Mythili, where we take a hard look at the major macroeconomic issues facing the country. Well, for this episode, we're joined by a very special guest, Dr. C. Rangarajan, who, as almost everybody knows, is chairman of the Prime Minister's Economic Advisory Council. But of course, he's a man in a varied career, has worn many hats. He's been governor of the Reserve Bank of India, he's been governor of Andhra Pradesh, he's been the chairman of the Finance Commission, and as was just said, he is the chairman of the Prime Minister's Economic Advisory Council, and as such has a very close insight into almost all the macroeconomic issues facing the country. Welcome to the show, Dr. Rangarajan. You know, we've always claimed that one of our biggest strengths is the fact that India is such a large domestic economy. Then how come that we were so adversely affected by the global slowdown? In fact, every time the government has to come out with an explanation, we're always told that it's part of the global slowdown. And if that is the case, then why is it we're not recovering with the rest of the world now?
The external shocks do affect the economy, particularly when they are as severe as they were in 2008. They do affect the Indian economy through the impact they have on India's exports, both of goods and services, as well as capital flows. We saw how the Indian markets behaved as a consequence of these shocks. But having said that, I would certainly say that the slowdown that we have seen in the last 2 years is due more to domestic factors than to external factors. Subsequent data do indicate that the economy was doing reasonably well in 2011-12. But 12-13 and 13-14, yes, the growth rate has slowed down considerably. It is due to a variety of factors, supply bottlenecks, price shocks, weakening of the investment sentiment. Therefore, I would not underestimate the domestic factors that have contributed to the slowdown.
Sir, if you have to prioritize the four major challenges, the low growth, the high inflation, the deceptively low current account deficit and fiscal deficit, how would you prioritize these in terms of importance, and which one would you like to address first?
Well, in some sense, the stability parameters have shown improvement. Inflation has come down, at least as measured by the wholesale price index. The inflation is below 5%. External situation is reasonably under control now. All estimates indicate that the current account deficit for this year will be 2% of the GDP. The fiscal consolidation roadmap is also now well laid out, and it is coming down. The fiscal deficit is coming down, even though it is a little farther away from the FRBM goal of 3% of the GDP. Emphasis on growth becomes more important, but we should not sacrifice the advances that we have made with respect to the stability parameters. I think we really need to achieve the potential that the Indian economy has got.
So if you have to prioritize, which one would you put first, growth or fighting inflation? Or does fighting inflation lead to growth automatically?
Well, I think that fighting inflation is important. Certainly, different arms of the government have different responsibilities. I think that is important to recognize. The monetary authorities will continue to emphasize price stability as the dominant objective, but at the same time, growth is important, and perhaps the role of the government in stimulating growth becomes even more important.
You talked about growth, sir, and there's been a lot of controversy now. What is the potential rate of growth for India? Can we hope to kind of get back to that 9 to 10%, or are we back to something like a neo-Hindu rate of growth? What would you estimate to be the potential rate of growth?
What is the potential rate of growth of the economy? I think the analogy is from capacity utilization. For example, in the case of capacity utilization, we take the highest output reached in the recent period as the maximum capacity and measure it in terms of that. Similarly, I would say that the potential rate of the growth of the economy is really the highest rate of growth achieved in the recent period, provided that rate of growth has been robust. I think the savings and investment rate are still high enough. Even as late as 2012-13, the savings rate of the economy was 30% of the GDP, and the investment rate was of course 34% or plus. Therefore, given the incremental capital output ratio of 4:1, which is the normal which we have seen in the last decade, the rate of growth of the economy should have been 7.5 to 8%. Therefore, I still think given this level of savings and investment rate, the potential rate of the growth of the economy is somewhere around 7.55 to 8%. If you are able to raise the savings rate and the investment rate to a much higher levels, we can go back to 9%.
So you talked about the high savings and investment rate, but the fact remains that the savings in financial assets, which is really the key number, has come down drastically. So unless we do something about that, and that looks very unlikely in the short term, that is on the savings front. As far as investment is concerned, the very fact that despite the relatively high rate of investment, it really hasn't translated into growth means the ICOR, or the incremental capital output ratio, is nowhere near the 4 that you spoke about. So what do we do on both these fronts?
No, I think the gross fixed capital formation rate, even according to the latest numbers, is somewhere around 31% of the GDP. Therefore, you are right. If the normal incremental capital output ratio had held good, we should have got something like 7 to 7.5% very easily. But we got less. And that, I think, is precisely because of the fact of the delay in the completion of projects, the lack of complementary investments, and perhaps in some cases the non-availability of critical inputs. Therefore, in my view, the most important thing that we need to do is to get the maximum out of the investments that we are making. I recognize the fact that the savings in the form of financial assets is much less than what it used to be as a proportion of GDP. We need to raise it. But certainly, even as of now, the gross fixed capital formation is high enough to give us the growth rate of 7.5 to 8%, provided we take action for speedy completion of projects, remove the bottlenecks that come in the way of the fulfillment of projects.
So on that note, we'll slip into a very short break, but we'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're going to be discussing monetary policy issues with Dr. Rangarajan. So we can now shift to monetary policy and the banking sector. Is there something ironic in the fact that just as the rest of the world, if you look at the US Fed and the Bank of England, they're shifting to somewhat nebulous objectives and targets away from a numerical target, we in India seem to be fixated on an inflation targeting method. Is there some disconnect over there? Are we behind the curve? Are we trying to reinvent the wheel, as it were?
Well, I think your interpretation is not quite correct. I mean, in the West, even today, they are able to talk about the other objectives as far as the monetary authorities are concerned because inflation is at a very low level. They have always considered anything beyond 2% as a high level of inflation or as an unacceptable level of inflation. Even today, their inflation remains below the acceptable level, and that is the reason why they are in a position to talk about other objectives like growth and so on. Therefore, I believe that it is not a deviation from the set of principles that they had earlier. Certainly in Europe, they have not even modified the mandate to the European Central Bank. Therefore, in my view, we need to give some precision to the concept of price stability. We always talk about price stability as an objective of monetary policy. What does that price stability mean unless there is some numerical association to it? Therefore, stabilizing the prices at a low level or an acceptable level is, I think, giving greater meaning to the concept of or to the objective of price stability.
So you would not look at the URJIT Patel committee recommendation of a flexible inflation targeting as very different from what the RBI has been doing all along, because after all the RBI has been targeting inflation. So in your perception, this is not very different from what the RBI has been doing, number one. And number two, in the Indian concept, in the Indian scenario, is it really feasible to be single-mindedly go in pursuit of inflation when there are so many other things that you need to keep in mind?
Well, as I was saying, that price stability has been treated or as a dominant objective of our monetary policy. In my view, inflation targeting, certainly flexible inflation targeting, gives greater meaning to that particular objective. Certainly, the central bank, the Reserve Bank of India, has been pursuing something very similar. In fact, even the Federal Reserve, for example, had always price stability as a dominant objective, but it never gave a concrete number or never announced a concrete number. Therefore, we are following something very similar to what we have been doing before. In fact, as inflation hovers below the threshold level, it is possible and it is desirable to reflect on other objectives and work towards the other objectives. It is only when inflation goes beyond the threshold level, you need to be focused more exclusively on controlling inflation.
Sir, a very key factor in the success of any monetary policy formulation is cooperation from the fisc and fiscal discipline. How does one achieve that? In fact, can you tell us how were you able to get the government to agree to phase out those ad hocs, and subsequent governments don't seem to have been able to imbibe that spirit of fiscal discipline?
Well, there are two problems. One is the level of fiscal deficit, and the other is the monetization of that deficit. When the fiscal deficit is high and then when it gets monetized, then automatically it leads to an expansion in money supply. Therefore, what we tried to do at that time in the early 1990s was to move away from the system of ad hoc treasury bills, that is the automatic monetization of the fiscal deficit. Subsequently, yes, there has been a movement in the same direction. After all, the FRBM Act was passed, and it mandated that the fiscal deficit of the government of India should not exceed 3% of the GDP, and we should move towards the revenue deficit being zero. We were by 2007-8 almost at the point of achieving these targets. But came the international financial crisis, and an expansionary fiscal policy was adopted, and we are in a situation in which the fiscal deficit is above the mandated level. But if you look at both the center and the states together, even today, I believe the fiscal deficit is a little above 6% of the GDP, which I think is the level at which the center and the states together should be. Right now, it is about 6.7 or 6.8. It is about 1% above the combined fiscal deficit that we should have. Certainly, I believe monetary authorities will have greater freedom only if the fiscal policy is also in sync. I would urge that we need a fiscal consolidation roadmap, and we should get back to the 3% level as far as the government of India is concerned as quickly as possible.
Well, on that note, we have to slip into a very short break, but we'll be back very soon to discuss the banking sector issues and possibly the external sectors as well. Welcome back. You're watching Macros with Mythili, and we're discussing with Dr. Rangarajan some of the key macroeconomic challenges before the government today. Dr. Rangarajan, another hot topic that is, in discussion every day almost is that of bank licenses. The first round of bank licenses was given during the time when you were at the helm of the Reserve Bank of India. How come one didn't see this kind of controversy and one didn't see this kind of, noise and commotion? Was it because corporate houses were kept out, number one? And secondly, my question is that if we give almost all term lending institutions bank licenses, where does that leave financing of infrastructure really in the economy?
Well, on the question of licenses, new licenses, we did in the early 1990s really a breakthrough, because for a very long time licenses had not been issued. And we could at that particular time identify a number of institutions which could be converted or which could set up banks. Now, the whole issue of whether corporate businesses should set up banks or not has been discussed at length. But I think the view that was taken was that that it could be done provided the fit and proper criterion is well understood and applied. Therefore, in some sense, I believe that the number of licenses that should be issued must depend upon the needs of the economy, not today, but a decade or 15 years from now. Because it takes almost about a decade or more for any bank that is set up to become a strong or viable institution. Therefore, we should look ahead as to where the Indian economy will be and determine the number of banks licenses that we should issue today. As far as the other question, the other aspect of your question is concerned, yes, I believe that we move to the universal banking model from the earlier system in which the commercial banks were looking after the short-term credit, and we had other institutions to look at long-term finance. I think we need to look at it, look at the problem again. I have come to the conclusion probably that given the requirement for large finance for infrastructure as well as manufacturing, the need for the long-term financial institutions specifically focused to provide it is really required. There are different models in the world. There are countries in which the long-term finance is primarily coming through the market. This is not happening in India, and therefore the need for setting up appropriate institutions with a focus on providing long-term finance to manufacturing and infrastructure is perhaps required.
Sir, we can shift to the external sector now. How do you look at the recent strengthening of the rupee? What does it really mean for export performance, and should the RBI intervene more aggressively?
Well, what is really happening is that the exchange rate of not only of the rupee as well as any other currency is no longer determined by the current account. The capital flows have an important bearing on the determination of the exchange rate. For example, when 2 years ago our current account deficit went up, the rupee should have depreciated, but it did not happen. Even last year, we had something like $88 billion current account deficit, but the capital flows were adequate to cover the current account deficit and add something like $3 to $4 billion to the reserves. Therefore, the rupee did not depreciate. Therefore, what is really required is to take a look at the real effective exchange rate. When the capital flows are large, we really need to prevent the appreciation of the currency in real terms. Capital flows have done us good as far as India is concerned, but it does not preclude keeping a watch on capital flows when they are large, and I certainly go along with the view that we should not let the real effective exchange rate to increase.
How would you look at the current account deficit position today? Is it sustainable, the improvement?
I think there is a very sharp improvement in the current account deficit. It is sustainable. If the world economy picks up, there are signs of it. Our exports can also pick up. As far as imports are concerned, there are some types of imports like gold, which had reached an abnormally high level because of the fact that inflation was running high in the country and gold became almost a hedge against inflation. That demand might be coming down, and we should really move towards the level of imports that we had prior to, let's say, a few years ago. That is something around $30 to $40 billion worth of import of gold may still be had, and still it can give us a current account deficit that is sustainable. I believe that going ahead over the next few years, the current account deficit can be in the region of 2 to 2.5% of the GDP. But certainly, I would urge that we really need to go even below that because even though the level of capital flows required to support that level of current account deficit may not be too large and maybe actually be forthcoming, we should work towards a lower level, but that should come through an appropriate domestic policy. It cannot come through the imposition of controls. And that policy framework should include taming of inflation, keeping the prices under control, which will help, as I said, promoting exports, as well as keeping the exchange rate at a comfortable level.
We're almost running out of time, sir, but one quick question. Can you give me 3 quick suggestions for any new government that comes to power?
Well, over a medium term, over a long term, there are many things that need to be done. We need to improve the expenditure on health, education. We need to promote skill development. But if you are asking me what needs to be done immediately, I would say that we need to quickly raise the level and composition of investment in the country. I think that is extremely important. And in that particular context, I would also say that some concerns have been expressed that because of the environmental requirements and so on, the implementation of projects, the sanction of the projects has been come in the way. Therefore, what I would really suggest is that we need to put in place very quickly a transparent policy with respect to environment, and therefore the new projects can come very quickly. And I will also add that we have now a Land Acquisition Act, and we need to watch it, and if there are glitches, we should remove them. Therefore, my really point is, let us try to push the investment to a much higher level. Let us improve the composition of investment in favor of infrastructure, and really look at environmental and land acquisition issues quickly. Some actions have been taken in the recent past, and we should accelerate these actions even more so that we can achieve this higher level of investment. And this will lead to the higher rate of growth, which I think is the potential of the country. And as they say, that the best way of predicting the future is to make it happen.
Well, I'm afraid that's all the time we have in this episode of Macros with Mythili. Thank you so much, Dr. Rangarajan, for joining us and giving us those very special insights. Thank you also for watching. But we'll be back next week again with yet another episode of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.